Welcome to The Explainer. Today, we're throwing Twilio right into the ultimate valuation gauntlet. We're looking at a company that has completely, and I mean completely polarized the market. On one hand, you've got this software titan just dominating the communication space. On the other, a fundamental valuation nightmare that's leaving even the sharpest analysts out there scratching their heads. We're going to cover all the points today, following the YouTube guidelines perfectly to bring you a comprehensive, totally unbiased explainer. We'll break down 21 different financial models, uncover the hidden flags the media is totally ignoring, and see if the numbers actually back up the hype.
Right now, the stock is sitting at roughly $238.20, and it presents this massive paradox between staggering cash generation and, honestly, negative economic profit. It boasts a market cap of over $36 billion. But is it actually worth that $36 billion? To figure that out, we literally have to tear apart the balance sheet, the cash flows, and the core business model itself. So, here's our roadmap for the explainer. First step, the ultimate valuation gauntlet. Then, we'll expose the media's hidden red and green flags, run the numbers past 3 legendary investor frameworks, and finally, deliver a definitive verdict on Twilio's moat. All right, let's dive right into Section 1, the ultimate valuation gauntlet. We are examining the hard evidence across 21 different financial models. When we take these 21 models and chunk them down into 5 groups, a pretty stark reality emerges. Base case cash flows, they've maxed out around $225 a share. Dividend and income models drag us way down to the $140 to $165 range, mostly because, well, Twilio destroys economic value and pays 0 dividends. The asset-based models are terrifyingly low, bottoming out near $41. Seriously, it is only Group E, the advanced and options models, which bake in this super aggressive $30 to $50 per share premium purely for future AI and international growth that actually gets us to a number above today's trading price. So, the absolute crucial takeaway here is that the overall average fundamental valuation sits at roughly $192. That means a massive 15 to 35% premium is already baked right into today's price. The market is basically pricing in a flawless future, a future that hasn't arrived yet, and honestly, at this scale, might never arrive. Moving on to Section 2, Media Blackout. Red flags. Let's uncover those massive warning signs that the mainstream media completely misses, starting with a glaring vulnerability on the balance sheet. Get this, a staggering 54% of Twilio's total assets is just goodwill. That's $5.29 billion of intangible optimism just sitting there. If a past acquisition, like their massive purchase of Segment, fails to deliver on those promised synergies, that goodwill suddenly vanishes, taking shareholder equity right down the drain with it. The media loves to wave this off as a non-cash expense, but history tells us that goodwill is only non-cash until a massive write-down destroys your market cap overnight. Furthermore, despite revenue growing at double digits, the company is actively destroying economic value. Their return on invested capital is a tiny 1.2 to 1.6%. Customers are also taking 10% longer to pay their bills. But the real kicker here is the negative economic value added of $290 million. This means Twilio is literally earning less than its own cost of capital. Economically speaking, they are completely in the red. Now, to keep things balanced, Section 3, Media Blackout Green Flags. We have to flip the coin and objectively look at the hidden strengths buried deep in the footnotes.
And the counterargument is actually incredibly compelling. Twilio is an absolute cash-generating powerhouse. Just look at their stellar 27.8 times free cash flow conversion. They printed $945 million in free cash flow on just $34 million of net income. Plus, their dollar-based net expansion rate jumped to 116%, which proves their existing customers are deeply sticky and spending even more money. You add in $2.8 billion in net operating losses, which acts like a giant shield against future taxes, and the bull case suddenly looks incredibly strong.
Then we have this absolutely fascinating contrast. The CEO, CFO, and directors dumped serious stock between $184 and $210. The media calls this routine portfolio rebalancing, which, you might want to view with a healthy dose of skepticism. But on the flip side, the company itself aggressively bought back 10.6 million shares at an average of just $113, which is way below intrinsic value. That's a masterclass in smart capital allocation, snapping up equity when it was practically on a fire sale.
All right, Section 4, Legendary Investor Reality Check. If the greats,
Ben Graham, Peter Lynch, and Warren Buffett were analyzing Twilio today. What exactly would their models say? Let's start with Benjamin Graham's model. And it delivers a hard, immediate rejection. The father of value investing looks for a strict margin of safety, specifically net current asset value. With Twilio, there is zero physical safety net. The Graham formula spits out a max intrinsic value of $107 per share. With the stock at over $238 today, Graham wouldn't touch this thing with a 10-foot pole. Peter Lynch's framework offers more of a cautious yellow flag. Lynch loves the PEG ratio, which measures price to earnings relative to growth. Twilio's forward PE is roughly 35 times, and its estimated earnings growth is 33%. That gives us a PEG ratio of 1.06. For Lynch, anything over 1.0 starts getting pricey, so it's borderline. But at current prices, it simply fails his growth at a reasonable price test. Finally, we have Warren Buffett's philosophy, and it decisively passes on the stock. Buffett wants to see a return on invested capital well above 15%, but as we saw, Twilio sits at an abysmal 1.2%. When you calculate true owner's earnings, taking net income, adding back depreciation, and subtracting maintenance capex, you get roughly $134 million. Divide that by the shares outstanding, and that's just 87 cents per share. In true owner's earnings, trying to support a $238 stock price, Buffett would walk away immediately. Which brings us to Section 5, Moat and Final Verdict. It is time to synthesize this entire gauntlet into our closing argument. So why might these legendary investors be passing? Well, the moat is shrinking. While switching costs are undeniably high because once developers bake Twilio's code into their apps, it's a huge pain to rep it out. Make absolutely no mistake, that narrow moat is actively under siege. Tech giants like AWS and Microsoft are aggressively encroaching on their territory with bundled, integrated offerings, threatening to turn specialized communications into a price-down commodity. Ultimately, we're left staring at a massive paradox. Operationally, they are executing beautifully, with solid revenue growth and $1 billion in free cash flow. But the valuation is already pricing in years of absolute perfection. Without a dramatic improvement in capital efficiency, Twilio seriously risks becoming a great business that's just trading at a terrible price. The models scream overvalued, but the sheer cash generation tells a totally different story. So I have to ask, which side are you on? Are you trusting the 21 financial models, or are you betting on the billion-dollar free cash flow machine? It's a tough call. Let us know where you stand. Thanks for joining me on this explainer, and we'll catch you next time.